We begin with Chapter 15. In this chapter, we will analyze in detail the Long Strangle strategy. The Long Strangle position is used when the market outlook is bullish or bearish. That is, we expect a sharp move in the stock price in either direction. The strategy consists of buying an out-of-the-money call and an out-of-the-money put with the same expiration date. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. The debit paid to initiate the position is given by the premium paid for the call plus the premium paid for the put. With this strategy, we can make profits in either direction. The maximum profit to the downside is limited, but it can be very large. The most we can make is equal to the strike price of the put minus the debit paid multiplied by the number of shares. This occurs if the stock price falls to zero. The maximum profit to the upside is unlimited because the increase in the stock price has no limit. On the other hand, the maximum loss that we are exposed to is limited. The most we can lose is equal to the debit paid multiplied by the number of shares. This strategy has two break-even points. A break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the put minus the debit paid. Break-even point 2 is equal to the strike price of the call plus the debit paid. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a profitable situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a losing situation. The great advantage of this strategy is that the loss that we are exposed to is limited, and the profit we can make is practically unlimited in either direction. If possible, especially for beginners, it is always recommended to choose strategies that expose us to limited loss and unlimited profit. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the total debit paid. An increase in volatility helps the position. Time decay hurts the position. With respect to exit conditions, to fully close the position, we must sell the call and the put. If the stock price is lower than break-even point 1 or higher than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In the case that the stock is trading at a lower price than break-even point 1, the position can be partially closed by selling only the put. Thus, we can hold the worthless call in case the movement of the stock changes. In the case that the stock is trading at a higher price than break-even point 2, the position can be partially closed by selling only the call. Thus, we can hold the worthless put in case the movement of the stock changes. As we will see later in an example, this can result in a large increase in our return on investment. The Long Strangle strategy is generally used when we expect an event in the company that may cause a large move in the stock price, in either direction. Remember that with this strategy, we can make profits both to the downside and to the upside, so what we expect is a strong move in the stock, no matter what direction it is. The events that can cause a large move in the stock price may include the earnings reports, which are released quarterly, the release or approval of a product, a business deal, or a court judgment. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And, finally, at options expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the gap between break-even point 1 and break-even point 2 increases. And as the gap between the break-even points increases, the range of prices for which we are in a losing situation increases. Therefore, in this case, time decay hurts the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Google company. As we can see, on July 7, 2011, the company was about to report earnings in 1 week. As we said, on Thursday, July 7, 2011, Google was about to report earnings in 1 week, so we could expect a big move in the stock price. In order to take advantage of that, suppose at that time we had decided to enter a long strangle. At the close of that day, Google was trading at about $546, while the options expiring in August 2011 had a premium of $19 for the 550 strike calls and $17 for the 540 strike puts. Thus, we could have bought one call with a strike price of $550 and expiration in August 2011 at $19, and one put with a strike price of $540 and same expiration at $17. With one contract, we would be in control of 100 shares. So the long strangle would have cost us $36 per share, that is, $3,600 overall. Notice that both the call and the put are out of the money. A few days later, after the market close on July 14, the company reported earnings. As the reported earnings were higher than expected by the financial analysts, the stock opened the following day with a rise of 13%. That can be seen here. We initiated the trade on July 7, and a few days later, after the market close on July 14, the company reported earnings. As the reported earnings were higher than expected, the stock opened the following day with a rise of 13%. At that time, the premium of the call was $51, and the premium of the put was $2.5. If we had closed the position at that time by selling the options at those values, we would have received a credit of $53.5. So our profit would have been $17.5 per share, because we had placed the trade at a debit of $36 per share. Thus, we would have had a total profit of $1,750, making a 49% return on investment in only 8 days. That is, we made $1,750 by investing $3,600. If we had sold only the call, we would have made a 42% return on investment, as we had sold at 51, making a profit of $15 per share. That is, we made $1,500 by investing $3,600. So, we would be holding the put in case the movement of the stock changes. Of course, by not selling the put, our return is a little lower. But if later the movement of the stock changes, that may result in a large increase in the return on our investment. Later, on expiration Friday, August 19, the stock closed at $491. That can be seen here. After reporting earnings, the stock continued to rise for a few days, but then started to fall until it closed at $491 on the expiration date of the options. At that time, the put expired in the money, So if we had held it, we would have made an additional profit of $49 per share, as the strike price was $540 and the stock price was $491. Thus, we would have had a total additional profit of $4,900. Therefore, as we had made $1,500 with the call, our total profit would have been $6,400, making a 178% return on investment in only 43 days. That is, we made $6,400 by investing $3,600. Remember, this would have happened if we had sold only the call and we had held the put to expiration in case the movement of the stock had changed. In effect, that happened, so we would have finally made a profit of $6,400. Here we can see the numbers of our example. The strategy consisted of buying one Google call with a strike price of $550 and expiration in August 2011 at $19, and one put with a strike price of $540 and same expiration at $17. The debit paid is equal to the call premium plus the put premium. In our case, 19 plus 17, which is equal to $36. Therefore, our investment is equal to 36 multiplied by 100, which is the cost of the strategy per contract, multiplied by 1, which is the number of contracts. That's a total of $3,600. This money is debited from our account. The initial margin required is equal to the 100% of the total debit paid, that is, $3,600. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit to the downside is equal to the strike price of the put minus the debit paid multiplied by the number of shares, that is, $50,400. This occurs if the stock price falls to zero. The maximum profit to the upside is unlimited, because the increase in the stock price has no limit. If we had sold the call at 51 and the put at 2.5, we would have made a profit of $1,750. On the other hand, the maximum loss that we are exposed to is equal to $3,600, that is, the total debit paid. Regarding the break-even points, break-even point 1 is equal to the strike price of the put minus the debit paid. In our case, 540 minus 36, which is equal to $504. On the other hand, break-even point 2 is equal to the strike price of the call plus the debit paid. In our case, 550 plus 36, which is equal to $586. Here we can see the order we must enter to open the position. It is an order with two legs. Leg number 1 corresponds to the long call and consists of buying one Google call with a strike price of $550 and expiration in August 2011. Leg number 2 corresponds to the long put and consists of buying one put with a strike price of $540 and same expiration date. The entered price is given by the sum of the purchase prices of the call and the put. In this case, 19 plus 17, which is equal to $36. This is the money, expressed per share, that will be debited from our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with two legs. Leg number 1 consists of selling the call we had bought. Leg number 2 consists of selling the put we had bought. The entered price is given by the sum of the selling prices of the call and the put. In this case, 51 plus 2.5, which is equal to $53.5. This is the money, expressed per share, that will be credited to our account when the order is filled. Here we ended with the chapter Long Strangle. In the next chapter, number 16, we will analyze in detail the short strangle strategy.